Look at me, I've got a yellow card, I've got a coral card.
What do you think the execs should now do to preserve the relevance of their banks?
You wouldn't build your fintech to run JP Morgan. It's a waste of resources. Investors expect certain returns because they extrapolate out. The large banks that were driving for change, because not only the barbarians are at the gate, but they need us protect. He's spending something like 17 billion in IT change.
Yes.
And he said, if I could spend double that, I would tomorrow.
It is so nice to sit with somebody who's from fintech and they have made the whole 9 yards of the journey.
It's very expensive to have deposits and not be able to lend them out. Have you got product market fit? It shows that there is a latent demand for customer-first banking.
Singapore ran out of rice bags because they've identified their customer segment really well.
It's incumbent on all of us to be ready for when it's ready.
If you don't know why the name is In The Grill, wait till we ask the questions. Hey guys, welcome back to this amazing episode of In The Grill. And this is part 2. If you've not watched part 1, please go back and watch it, and we really appreciate your support. We are continuing our conversation with Gareth Richardson, who is the CEO of Thought Machine. Gareth, great conversation.
Thanks for having me.
And, we call this season, like this series In The Grill for a reason. So let us bring you back into the grill mode. Funding winter is basically a topic that has been discussed and over-discussed.
Yeah.
But very few people bring in the perspective that you do, in my opinion, because you are funded with investors as well.
Yeah.
So funding winter, in my view, would have hit you in 3 different ways. 1, obviously, you have to look at your own plans.
Yep.
Your investors are asking tough questions. 2, a lot of your early customers were these neobanks, Digibanks, etc. They get hit, so their funding is hit. So obviously that is a big, challenge. And the third part is that now the incumbent banks are no longer as worried about these digital and neo-only banks.
Yep.
So the perspective you will bring on funding winter is going to be amazing. Now you bring an amazing perspective to this, right? So we'll peel it off one segment at a time. The first segment is some of your customers, obviously, are getting hit. So how did the customer conversations change as they're not able to raise funds? And, how are their strategies changing during this time?
Yeah, you've got to look at our customer base in 2 ways.
Yes.
You've got to look at a customer base as the large systemic banks.
Yes.
Which was the majority of our revenue and retains the majority of our revenue, but wasn't the majority of our growth, if you like, because they're a long process, as we've been talking about. They're 5 to 10 years, blah, 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 blah. So we always plan to have digibanks, fintechs, smaller banks filling in that piece because we said we would never get fit if we didn't have those, because we could just wait for ages and then find out that we could never go live if we didn't go live with smaller institutions beforehand. So our biggest growth was in certain markets like Asia for digital banking. Was that we did 50% of our deals in 22 and 21 in Asia, which just dried up pretty much going forward. But in terms of, but we weren't exposed in the way other neobanks were, because we had the more strategic banks, if you like. Yeah. But it meant that our revenue profile changed pretty drastically, and we had to be very clear about what features we were going to build, what we were going to worry about, how we had to cut our own cloth in terms of operational costs that we were running and get fitter. So I think in some ways, as always with these things, never waste a crisis. It's been very good for us. Yes. In terms of operationally making us fitter and making us stronger. But it's also been hard, right? In terms of whenever your customer base pretty much disappears overnight, or a key part of your customer base disappears overnight, it's very hard to adjust. Even if you're a nimble fintech that can do these things, your investors expect certain returns because they extrapolate out. You make decisions and funding investments based on certain amounts of money to come in. And that sort of pipeline then sort of becomes a bit of a problem.
Okay. Now we are going to take a few different folks out of it. And hopefully you like these folks more. And walk us through how the conversations with investors change, because obviously they like logo growth. They like to see more logos on the slide each time they come back and see you, right?
Sure.
So there is logo disappearance happening now of a sort. So what were their conversation? And say when this funding winter hit, you were already on your path to IPO, right? You were obviously well established by that time. So how did the investor discussion change for you?
Look, I think the path to IPO moved out, obviously.
Yeah.
We also saw. I think if I put all things together, when we were chatting to the investors, it was about making them aware of that discussion, right? So you just laid it out very well by going new name logos slowing up, but barbarians no longer at the gate for large banks, and so that they didn't need to feel they were going to have their most profitable customers taken by by those banks, by those new fintech banks or startup banks, challenger banks. But the bigger piece also happened at the same time, which is net interest margins went up, which meant that the large incumbent banks started printing money. Let's be honest. And off the back of that, the customers that weren't profitable before become profitable.
Yes.
So they're less worried about you taking away the small slither of profitable customers, because now they've got a much larger customer base to run their profits over and run their costs over. So it had other impacts in that the large banks that were driving for change, because not only the barbarians were at the gate, but they needed to protect their most profitable customers and reduce their costs across the board on others, didn't have as much impetus to do that.
Yes.
So we had to have that conversation with the investors. Look, this is the reasoning. This is the macroeconomic environment that we're in. Obviously, we need to do some things to preserve some cash for a bit longer, because we're going to have to run for longer and other things. But we also became less fixated, or the investors became less fixated on growth and more fixated on where's that break-even point, what's the investment for, where are we getting to? And we had a good plan for that to start off with, but it had to get thrown in the bin, reshaped several times on the way through to get to that point.
And that is very honest. And you also answered like the next part I was all about to ask you: how were the incumbent banks, reacting when the barbarians were not on the gate? So thank you for answering.
But you also, I see it going in two different ways. You have some that go, this is an opportunity that we must not miss.
Yeah.
And we are going to double down, and we are going to come out of this stronger. Just look at Jamie Dimon's investor letters and other things. You can see all of that in there. He said if he's spending something like 17 billion in IT change.
Yes.
And he said, if I could spend double that, I would tomorrow, if it got me live tomorrow.
Right.
So you see that side of things. And then you see the other side of things going, oh, we're returning money to shareholders. We're doing those sorts of things.
Yeah.
And it's like, you have good uses for that money, but you're doing that for a choice, for a reason.
Jamie Dimon is, one of the outliers of the industry. So, and Mr. Jamie Dimon and the PR team, whenever you want to come and sit in the seat, it is always open. We will be very happy to do it. And see, this is exactly the challenge for the industry, right?
Yeah.
There is a lot of inertia towards moving towards this. The net interest income was so high, interest margin, was so high that, people did not want to change. Interest rates are getting cut as we speak. What do you think the execs who are in this decision-making position should now do to preserve the relevance of their banks?
See, I've always felt somewhat incorrectly at the start, but I think I'll be proven correct long term, was I always felt that as soon as interest rates came back, the banks would find it too expensive to just keep competing with interest rate.
Yeah.
As it is, customers have been very willing to move their deposits very quickly and to follow that. But you're starting to see that competition come in and become expensive. So you're seeing in places like India with the mutual funds being much higher, and you're seeing a rush of deposits moving out to mutual funds out of the main banks. You're starting to see competition coming from other areas. What we previously saw when there was those sort of interest rate competition was that people tried to, again, hold on to their customer base through innovation on product. What we're seeing today is product distribution innovation, not product innovation.
Yeah.
And I think we're going to start to see bundling, things like that, where you can start to, we had offset mortgages in multiple countries that were pulling together, so, your savings offset you with your mortgage, so you lower your interest rate so that you can't compare one to another very easily. I think we're going to start seeing more of those to sort of to maintain customer base within there, maintain profitability of customer, because we're not going to drop to zero interest rates again. We're not going to be in ZIRP again. So we're going to see, but we are going to see a reduction back down, because we can see from the economies can't handle interest rates at the same level. So that would then get into a more stable period. And then I think you're going to start seeing innovation. And at the same time, you're going to see boards who have got used to that net interest margin are going to start saying again, hey, this is what you did last year.
Yep.
We now want better than that. And that's going to then drive back to innovation.
Right. And you bring out a very, interesting fact here, because see, what has happened is there have been a lot of volatility. So obviously, deposits moved into what was perceived as more secure banks.
Yeah.
Interest rates were really high. There was not only India, but I have to give you an example. In Singapore, the bank is paying like 0.05%. And then there are fintech platforms which are offering money market funds, which is 3.7. And then these guys have seen a massive flow of funds from banks to them, to the extent they've increased their fee 200-300x percent. Sorry. Wow. So, it is a low base effect. It went from 0.05 basis point to 15 basis point. So, but what it says is, and they've not lost deposit, that banks might be caught off guard, as you were suggesting, that on this. And Singapore is seeing the same thing. Like, I see no reason to have a lot of money in a bank anymore. 0.05 is like I might as well burn the currency note. Like, guys, not going to do that. No. That is, a punishable offense.
Yeah, exactly.
So, exactly.
Especially
but
in Singapore.
Exactly. Yeah. So, but you get the, crux of it. Now, while we are at the topic of Singapore, you have a great partnership with Odex. Their CEO was our second guest ever.
It's great guy.
And, we have a very funny story, which I already told you. So I'm not going to repeat myself. And so they are banking as a service. You guys are core. How are you guys coming together to deliver something really special?
So we have our platform does a certain amount. We have a very strong view. We have a very strong view about what core should be and what it shouldn't be. And this is as important, as I said to you in the will not implement list on the roadmap previously. Yep. It's very important that we know what a core should be, because cores in this world have been everything to everybody for such a long time that it's a meaningless term, really.
Yeah.
But they should be product engines. They should go so far and they should stop, because there's best of breed and less fragility in the architecture if we do it that way. And what Kelvin offers for a lot of institutions is the other pieces of the plumbing around it that we're saying we will not do.
Yes.
Which gets closer to, if you are buying an FIS or an incumbent type thing, you would get a much larger footprint.
Yeah.
And what Kelvin and other teams have done, but Kelvin in particular, has built a set of these API first features that run around that enables a non-banking institution or even a bank to take those features and roll out, do better product distribution into their current existing flows.
Oh, nice. Kelvin will be on the show in like a few episodes. Any questions for Kelvin when he comes out?
No, I'm not going to put him on the spot.
Kelvin, I can tell you, he's asking, where is the pipipeline you guys promised you? Conversation.
I am not putting him on that spot.
No, I am kidding. And, it is so nice to sit with somebody who's from fintech, and they have made the whole 9 yards of the journey. You guys are obviously talking about an IPO. 2.7 billion is the valuation. Like what I read, obviously speculative. I won't put you on the spot.
No.
Talk to us about the journey of, once you say, yes, this will be a firm that will go through an IPO. What starts changing?
You can change as much or as little as you like until the point of saying, I'm actually going to do the IPO.
Yeah.
So if you set out on a journey to say this will be an IPO firm, then there's certain things you can put in place that make your life a bit easier. Compliance functions, finance functions get scaled up, etc. And you can do those things beforehand so that you're not ramming them in and you're not changing the culture, which is what a lot of people do when they go, oh, we're going from being this scrappy startup to being an IPO. Oh shit, we're now going to change. Sorry, don't know if I can swear on this.
Apologies. Yeah, please, you can.
I'm going to change the culture. I'm going to change how it all works. We've built that in almost from the start, given the size and scale of what we're doing. However, you have to then take that to another level. And you don't do that as a fintech or a startup. I mean, it's like lots of people say to us, why don't you build? We now have performance that we can prove for over a bank the size of JP Morgan, because that's one of our customers. You wouldn't build your fintech to be the size of to run JP Morgan when you're trying to run mocks every day. That's a waste of resources. Until you get a JP Morgan, there's no point building for that. Yeah. In the same vein, until you are going to IPO, you don't build some of these institutions to that level. That it's not worth it.
Yeah.
So but you have about 18 months, 12 to 18 months to do that. So you wait for that point. And when you know you're going to do it, then you do it. And if you start it and you change your mind, then you stop doing it.
Yeah.
And make sure that you got your plans in place. You know what you're going to do. I think it's one benefit for us. We work in a very regulated environment with some of the largest regulated entities who already want a lot of the insight and other things that you would get through a regulation posting. And we're also classed in some countries as systemically important for the economy. So we already have controls that are over and above what a normal sort of fintech would have. So in that sense, it's easier to do, but it's still about timing. It's still about changing those things.
And, a great answer. You've been very candid. It is very good to see that. Now, let me take you to the other extreme. You are a successful fintech. There is so many digital neobanks, etc. Hardly a fraction of them are profitable today. What's going on? Why are they not making money?
Well, I think some of them, it's a different position now. But if you go back, it's been different over the years as well. You saw a big drive of people setting up sort of in some different parts of the world. So let me try and not make sweeping statements that aren't true everywhere.
No, please do. We need viewership on the show, right?
But let's make some sweeping statements. Lots of people built deposit e-money licenses that just had a nice, shiny, different colored card. And that was your differentiator. That was up to about 2019. That was your way of differentiating. Look at me, I've got a yellow card. I've got a coral card. And that wasn't a profitable way of running a bank, but it was a way of investors getting you customers and those sorts of things. Some failed, some didn't even at that point. Then there was the chase for lending to try and start actually using those deposits, because it's very expensive to have deposits and not be able to lend them out. But surprisingly, so many people built their digibanks in that way, which was pretty crazy.
Yeah.
If anyone who's been in banking long enough knows you need a good balance of both. That's kind of the fundamental part of the business. And then they didn't build it with risk controls and governance properly in place. So they got stopped from going into certain markets or other things by regulators and other things. And you'll see that with the more successful digital banks have a full suite offering and have built compliance, risk and other things into that from the start. But you need a good balance. There are some people that we've seen who are more bankers that have built a new bank. And they end up building a bank that looks like HSBC from the start, and that is never going to be profitable at big phases. But then you'll see other banks that have built this from the start and are moving in the right direction. So I think, look, I can make sweeping statements across the board. It's really about certain parts that they have to drive for profitability. That has to be a goal. Whereas a lot of people don't have that necessarily. I haven't had that as a goal and now have it, which is then it's hard to shift if you haven't got the product stack from the start to be a bank.
Honestly, that was amazing, because I was thinking you will give like a short answer, but that was very, very well structured. And I'm going to ask you a question that I asked the CEO of Trust Bank. That was the first question I asked him when he sat down. but I will come to that after this. Obviously, you run two or like you have been so successful. What do you think are 2 or 3 existential threats to fintechs in their early stages?
And by fintechs, you don't mean fintech banks, I assume.
I just assume fintech. Like you are a fintech, not a fintech bank, right?
Yeah.
So a fintech.
It's all the classics. It's no, have you got product market fit? And have you truly got product market fit?
That is hard to determine,
It's hard to determine, but when you've got it, you've bloody well got it, and you can feel it. And I think that's the big change at Thought Machine. When you get that much interest from the industry coming in at the start, and you shape the product with the industry in mind, you get feedback pretty damn quickly. And it's about listening to that feedback and knowing where you get up to. And we pivoted what was in the box, if you like, a lot through those first couple of years. Even when I joined 6 years ago, and we were literally throwing bits of functionality out of the box quite readily at that point, getting down to what is the nub of what's really interesting. So product market fit, clearly. While you're doing that, funding, be scrappy, get the funding from where you need it from, and sell bits of services that you can do on the side while you're working those things up. Get those things going, be scrappy. But when you get to that right point, don't miss the pivot.
Yep.
I know this is all classic stuff, but don't miss the pivot. If you've got something and it's right, it's very hard to do. You've usually got a lot of interests against you doing it because they have jobs that they want to do and things that they believe passionately in. But don't miss that pivot. It makes it a huge point of being very focused about what you're doing.
I have 2 more questions. The first one is, this is the question that I asked Dwight when he sat in your seat. Singapore is an overbanked market. Why would it need another digital bank?
Well, I think I can't remember what Dwight said. I wish I could. But if you look at it from my perspective, yes, that's true. But you would argue that you can see the growth that Trust has had shows that there is a demand for a customer-led bank. With some sort of focus on the partnership with Fair Price has been a huge success. And I think that talks to how you build a fintech bank in these worlds, is getting that partnership that's compelling for customer, think from customer straight away. Go from, we always talk about customer first, but I don't think people really live it in terms of product build that often. So focus on it, do it, and execute it end to end. And they started that with Mox, with the huge work that was done there, with the partnerships that were run out of there, and then have just honed it, refined it, and ran it into Singapore. And it's done fantastically well. So, I'm not trying to be huge execution win, and Dwight's team have done a phenomenal job. But it shows that there is a latent demand for customer-led banking, customer-first banking. And if you can build that proposition in a compelling way with a single account that does all these things, that adds on, and I think they've launched 60 product features this year. So don't think, it's one and done. There's a huge amount of innovation going in that bank all the time.
And I'll tell you, like when Dwight sat and this is some time back, I love the clarity of thought the guy has. Like I was sitting there and I was like, and I told Dwight, I'm like, your clarity of thought is so amazing. Because obviously, they had this rice bag promotion and, like social media being social media, they're like, ha, we can get an iPad. So we'll not go and get an rice bag now, right? And Singapore ran out of rice bags because people were actually trying to get rice bags. They identified their customer segment really well, and then there were people who were tracking where can you open a Trust account so you can get your rice bag. So for me, Trust, obviously, technology is great enabler, but I think the driver of their growth is understanding that unique customer segment that they have. So they don't have to waste money on customer acquisition, but give the customer exactly what they're. So Absolutely. I want to do a case study on.
So you say, why does anyone need anything? But if it shows that there's not enough focus on customer.
Yeah.
And if you can go and target that customer with the most interesting, not even interesting, but target that customer.
Yes.
And that customer's large enough and interesting enough, then there's always a need for you. But that comes back to product market fit, doesn't it?
Yeah, exactly. And the, great answer. We're coming to the end, obviously, and we've not talked about the most interesting topic, AI. Tell us what you're seeing in AI. What are your thoughts about, the scale up that is going on?
Yeah.
And where do you think this is headed?
Look, it's hard from a fiscal sense to really make sense of the scale up that's going on and the amount of money that's being spent on this for the results that you can see at the moment. If you look at the pure economic terms of what the hyperscalers are spending on build out of data centers and other things, it almost feels like fiber broadband rollout back in sort of 2000, where most of it was dark afterwards.
Yeah.
But I think we're seeing such an innovation and such a change in some of the technology over time. I think it's incumbent on all of us to be ready for when it's ready. And there are certain use cases where it's very ready for too many readies, but we're really seeing that come through. As you said, with us, we worry about the data, and that's why we were set up, was to basically get back to being able to provide a single view of customer, a single view of all of those products. And that's very unique in the market. No, most people have come from silos that they've looked at. By silos, sorry, I mean current account, credit card, or something else. They'll go down all that silo, and then you'll have individual batches for each of those systems, whereas we can run all of those in one platform horizontally. That capability unlocks you to be able to do all the other pieces that run off the back of that. So I think there's the AI is incumbent on everyone to do the build out to be ready. There are certain places where it is ready now, but there are also huge potential that is being built as we speak to do that.
Thank you. And, thank you so much for going through the grill today, and I hope you come back when we do another season of this. And, thank you.